What is going on, you guys? Welcome back to the channel. Welcome back to another video. We have got so much to talk about today, and if you're stopping by the channel for the first time, please do your boy a favor, subscribe to the channel, and also smash that like button. Totally appreciate it. Monday's right around the corner. The banks are going to be opening the start of the week. What are you guys going to do with your money? How are you going to make this week different? See, the Federal Reserve has made some pretty dramatic impacts on our economy, on the U.S. stock market, on the real estate market, in the mortgage industry, in the job market. They've collapsed multiple banks. Well, technically, the Fed didn't collapse any banks. These banks that have already collapsed, Silicon Valley Bank, Signature Bank, First Republic Bank, they made decisions that put them in a situation that made them vulnerable when the Fed decided to change the game. And unfortunately, it caused them to be in a situation where they were insolvent. Banks collapsed. Now, a very similar situation is happening in households across America right now. And, Americans have, this is just like human nature. When you make more money, you tend to spend more money. And I don't think that there's anything necessarily wrong with that. There's nothing inherently wrong with that. But there's a problem when the ratios are out of control. When you get a little come up, when you get a raise, when you get a bonus from your job, if you work a 9 to 5, even if you're a sales position, you work a sales role, it's human behavior to want to increase your lifestyle. And generally speaking, the things that people want to upgrade, they want to upgrade their house, they want to upgrade their car, they want to upgrade their lifestyle. Take nicer vacations, take some trips, things like that. Nothing wrong with that, right? But the problem happens when we go too far, too fast. Now, one of the very first things that people will do is they will upgrade their car. And they'll upgrade their car to, something nicer than what they had. They might not run out and buy a brand new Lexus or BMW, or Mercedes-Benz or whatnot, a new Audi. They might just go out there and buy a newer, more fuel-efficient car with more amenities, but it costs more money. And they'll finance this car for extended periods of time, 60 months, 72 months, 84 months. I've seen like 108 months available on certain price points of cars, certain types of cars. Matter of fact, I think somebody told me in the comments that they had a 120-month car note. And I'm like, oh my God, this is just madness, right? But the problem with this is that most people don't understand that their money needs to go further than just this car payment. And this car becomes a pair of golden handcuffs because you're now forced to work a job. You're now forced to stay on your 9 to 5, whether you really like your job or not. You're forced to stay on this job to pay off this note, to pay off this loan. And the fact that cars have gotten so much more expensive, even though the car market's about to collapse, the cars have gotten so much more expensive over the last 2.5, 3 years, with cars being 10%, 20%, 30% over MSRP. You got people just desperate to buy vehicles. And, the simple fact of the matter is that these automakers, these dealerships, they realize that people were willing to just, hey, if they can get financed, they'll buy it. People buy nowadays on payments, not based on paying cash for stuff. Me personally, if it's a luxury item, go ahead and buy it if you can afford it, But if it's a luxury item, generally speaking, I want to pay cash for it. And if I choose not to pay cash for it, I may finance it at a very, very low interest rate, knowing that I have the cash in my savings bank account or in the stock market, invested in some equities that I could use to pay off this luxury item. I'm not going to finance toys that I cannot afford. And I'm not telling you how to use your money, but I'm just saying that this is a trap that most Americans find themselves in. And this is one of the top reasons why Americans cannot build wealth and they stay broke in America. And then when recessions happen and when the Fed raises interest rates, anybody who's got variable rate interest loans are getting just bent over at the countertops. Now, the wealth inequality in America is vastly skewed, mainly in the stock market. Now, if we look at the stock market, anyone can get started in this. Anyone can get started investing in the stock market. You got ETFs, index funds, and mutual funds all day long that people can invest in with minimal to no experience whatsoever in the stock market, and probably will do just fine. Why? Because ETFs, exchange traded funds, are very diversified collections of stocks that are put together. And so you got stock market diversification. And if you look at pretty much any S&P 500 tracking ETF, it's got for the most part, 9 times out of 10, it's got a positive rate of return somewhere between 10 and 11% over the last 10 years of tracking the ETF. So most people will make money just simply buying an S&P 500 ETF. Doesn't have to be anyone in particular. It could be Vanguard, iShares, Charles Schwab, you name it. But a lot of people are so busy trying to maintain an image, trying to cover this hefty car payment, or trying to cover this hefty mortgage payment that was just more than they really should have bitten off. But of course, the bank said, okay, the bank's going to lend me the money. I might as well go ahead and take it, right? So, Americans are saddled with high interest debt. And this debt is preventing them from building wealth. But more importantly, it's putting Americans in a position where any shift in the economy, any shift in the federal funds rate, any shift in the Fed deciding to modify interest rates can make your job employment, it can put your job at risk. And if your job is at risk and you have an interruption in your income, all of a sudden you may have your vehicle repossessed. You may have your car repossessed. You may have your home foreclosed on. And so, obviously we want to avoid these situations at all costs. Now, the wealthiest 10% of Americans, they own about 90% of the US stocks that are held. And so, well, what does this mean? Well, this means that, like, if you walk down the street and you passed, 10 people, one of those people owns 90% of stocks in the stock market. Meanwhile, the other 9 people, they're collectively owning the remaining 10% of the stocks in the stock market. And why is this? Well, there's a number of different reasons, right? One of the reasons why it is so skewed, though, is because Americans are so saddled with debt. Now, obviously, there's income variances, there's income differences between the top 1% and the bottom 99%. But by and large, most Americans do not prioritize investing. They will prioritize consumerism and buying stuff. And I was a victim of that. That was one of the huge mistakes I had made for many, many years before realizing that this doesn't make any sense. Why are we doing this, right? Now, the top 1%, they gained probably close to $7 trillion in corporate equities and mutual fund wealth during the pandemic. So meanwhile, while most people were out shopping and spending and, living off of stimulus checks and whatnot, PPP, EIDL loans, consumerism, they were blowing money. The top 1% were building their wealth because the top 1% gained almost $7 trillion in corporate equities during the pandemic. We saw stocks like Amazon and Wayfair, all sorts of consumer-related stocks going through the roof during the pandemic because people were shopping. And evidently, they were shopping way more than they were when the economy was open. And guess what? The bottom 90%, they only added $1 trillion to their net worth through corporate equities and mutual fund wealth during the pandemic. So vastly skewed apart, right? Vastly skewed apart. Now, if we look at, if we look at the bottom 90% of Americans, they only hold about 11% of, individually held stocks. Now, this number, this really needs to change. Americans need to prioritize financial freedom. Otherwise, most Americans will continue to be in a situation where, you know, you're at the mercy of your employer. And during times of a recession, when the Fed is hiking interest rates, generally speaking, as interest rates go up, so does unemployment. And you don't want to have the music stop and you don't have a chair to sit down on. So, you know, this is a common issue that a lot of Americans are dealing with right now. I mean, we just hit record numbers of credit card debt. We're close to like $1 trillion in credit card debt across all Americans right now. These are unprecedented numbers. And so we're seeing unprecedented numbers in credit card debt, and yet the top 1% is steadily making way, going further and further, building their wealth further and further. At some point in time, I would hope that there would be a shift. Now, you know, stock market's role in increasing wealth equity has played a tremendous part. In fact, the stock market was one of the main sources of wealth creation right here in America during the pandemic. You know, the stock market was a main driver of wealth inequality, in spite of the fact that online brokerage firms like M1 Finance, Robinhood, Moomoo, wiill, they have all made it so easy for people like me and you, just regular people, to go online, set up an online brokerage account. You can create a taxable trading account, an IRA, a Roth IRA, a traditional IRA. You can leverage your 401k through your employer. Most employers offer that, and then they offer matching, usually up to like, you know, 3, 4, 5%, 6%. So it's like free money that a lot of people are passing up on. You've got all of these different brokerage apps available on the phones, but most people are out there stunting on the gram, flexing on Instagram, flexing on Facebook, TikTok, Snapchat, and it's like, for what? For what? You know? So the wealth of the top 1% now tops 32%. These are records that are being hit. And you got big name companies that have contributed to the wealth of the top 1%, like Amazon, your Apples of the world. You got Facebook, you got Google, Microsoft. So all of these companies, they have been hitting record highs in their revenues, in the demand of their products, mainly due to consumerism, mainly due to people out there putting items on credit cards that they have no intentions on paying off at the end of the month. And, you know, if your goal is to get to financial freedom and to build passive income and to be able to live your life on your own terms, this is rather detrimental, to say the least. So, you know, that's the situation that we're in. And millions of new investors, they actually came into the stock market for the first time during the pandemic. But we need more of them. We need more of them to really shift the numbers to, you know, so that the top 1% doesn't keep putting lengths on us and leaving us in the dust. Robinhood added more than 10 million new accounts, new brokerage accounts over the last 2 years, and they now have well over 22 million accounts on their investment platform, which is pretty astounding growth. And many new investors, you know, many of the new investors that have joined Robinhood, they're new, young, first-time investors. Like, these are people who are investing in the stock market as a beginner for the very first time. And so, you know, it makes you wonder, will the millennials change the game? Will the millennials come in and say, you know what, with all these different investment apps, you know, Robinhood and whatnot, I'm not going to be broke anymore. I'm not going to be slave to my car payment. I'm not going to have to worry about my car getting repoed or repossessed. My family tree, my family lineage is going to be different. Maybe it happens for the millennials. We have to see. And you got big name companies that attracted new investors during the pandemic, right? Y'all remember, you know, Coinbase? Like, pretty much you couldn't buy Ethereum, Ripple, Shiba Inu, Cardano. You couldn't buy any of those. You couldn't buy any of those altcoins without buying Bitcoin first. And for the most part, you bought Bitcoin through Coinbase, and Coinbase's stock price went through the roof because a lot of people were messing around with cryptocurrency during the pandemic. So Coinbase's stock ran up and drew a lot of attention from new investors during that time. And it's still a very solid company. Very solid company. I mean, they have built a great foundation. Moderna was another stock that was running up for you know, obvious reasons. Then you had Peloton, you know, they had great marketing. You could exercise at home, you know, phenomenal product, definitely pricey, but hey, money is no object when you got credit cards, right? So might as well go ahead and swipe that American Express on there. You had companies like Zoom, you had companies like Tesla, and basically, you know, like, these were the kinds of companies that were really attracting the new investors. These were the, what do you call those? These are the meme stocks. Well, at least some of them were. These were meme stocks. Everybody was talking about, everybody and their brother was talking about them. And so this was actually kind of good. It was like good and bad, but it was good because it got a lot of younger investors involved in the stock market. It got them interested, right? But also, you know, there's like unequal gains and wealth distribution. Like the gains and the wealth that was created in the stock market, they're not being more widely distributed. Why? Because you know, it's skewed to the top 1%. The top 1% owns most of the stocks. So, but this can change. This can change if more and more people were to prioritize investing, right? If more and more of the 99% were to prioritize investing, the top 1% wouldn't have so much power and influence over the bottom 99%. But it takes a lot of collective ideological shift. Let's save that for another video, right? Now, an army of new investors, you know, it's a lot of people, right? But it's still small in comparison with the average account size at Robinhood. Like, you know, with all of these people all of these new investors who started hitting the stock market and investing for the first time, the average brokerage account over at Robinhood is only $4,500. The wealthiest investors, you know, they had hundreds of thousands, even millions in stocks. And so having that much in stocks, even as stocks only go up like 1%, 2%, 3%, they're able to add millions of dollars, hundreds of thousands of dollars to their portfolio, just with marginal movements with the stocks. And so this is why it's so important to start early, to start small, even if you have to start small, just to start, you know, and work to increase your income through raises, through bonuses. Maybe you need to switch jobs. Maybe you need to start that side hustle. Maybe you need to start that home-based business. You know, if you guys want to learn more about different home-based business ideas, different online business ideas, side hustle ideas, hit me up in the comments down below. Let me know if you guys want me to share more information and ideas on those subjects. I would love to. But these, you know, you got to hustle. You got to sacrifice if you want to get ahead. You know, I wasn't blessed with, you know, being the son of Elon Musk or the son of Jeff Bezos. So I had to get out and grind. And most people will not be the sons of wealthy people. It's just statistically not in your favor for that to happen, right? So, you know, that's just the way it is. So we got to grind. There's got to be a little bit of upfront. There's going to be a little bit of upfront sacrifice. But once you get it going, you start compounding your money, start compounding your wealth, start making some serious traction. So, you know, keep in mind, the top 10%, they saw their value of the stocks that they held gain between 43% from January 2020 to 2021. That was only 1 year. It was like a year and a half. But, you know, from January 2020 to June 2021, it was a 43% gain. So that's like saying, all right, you had $1 million invested. A year and a half later, you had $1,443,000. So you gained $443,000 doing nothing, completely passive income, thanks to the stock market. So when I realized the power of compound interest and the power of leveraging the stock market, I personally said to myself, you know what, enough is enough. I drove a beater car, and as much as my friends made fun of me, I knew that prioritizing investments over liabilities, assets over liabilities, was going to be worth it.